Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest on the show, just head on over to missionmatters.com and click on Be Our Guest to Apply. All right, so today I have Larry Kriesmer on the line, and he's CEO over at Measured Risk Portfolios, Inc. Larry, welcome to the show.
Thanks, Adam. Pleasure to be here.
All right, Larry, so we got some lifting to do today. I'm excited to get into SynthEquity, which is an options-based investment approach, and it's combining the benefits of the long-run, uncapped upside potential of the S&P 500 with proactively defined calendar year risk. So we're going to talk about exactly what that means and go and dig and look under the hood of SynthEquity, so to speak. But before we do that, let's get a little bit into your background. So how did you get into the business? How did you get into finance and investing?
I would have to say I stumbled into it. When I graduated from college, I got a real estate license and thought that was going to be the way I was going to go. And based on the time of the year or, the markets, I got zero. It was like crickets in trying to get into that business. And I was actually referred into the financial side of the business through my now father-in-law. And that's how I kind of got into life insurance first and then wealth management second.
What kept you around? I'm curious. Like some people, they get into the business for a bit and maybe they kind of burn out or they move on to the next thing. Like what kept you going? Like what interests you about this business?
For me, it's problem solving. I love problem solving and trying to figure out how to grow wealth without getting your, if you can say, ass kicked on a podcast, but without getting your ass kicked is okay, good. That really was the thing that, and it still keeps me on my toes because it is a brutal world out there and there are people trying to reach into your pocket and take your money.
Yeah.
And, my story is framed in large measure through an experience with my dad. He was an engineer, went over to Saudi Arabia when he graduated from college in the 40s and worked for the whole time with a big oil company and then retired, brought all that money back and decided instead of taking a pension, he could do better with hiring professionals. Invested in a company called Technical Equities up in Northern California back in the 80s. And about a year later, that whole enterprise had unwound as a Ponzi scheme. So I have a very, very near and dear kind of desire to be able to provide a structure that allows for tremendous transparency and structure that is also really in large measure immune from a wipeout. Because ultimately my dad, he lived much longer, but he had to go back to work. But I would say looking back on this, I feel like I lost my dad as a result of that loss. And I just don't really want to have people have to go through that same experience. And it happened, in my case, it was a financial disaster, but other people don't have to have that bad of a loss to have the same kind of crushing blow to their psyche. And really what it turns out to be is that there's another way to do things, and that's what we're doing.
Yeah. Tell me about really the formation of measured risk portfolio and portfolios and how this company came to be.
Yeah. So we were trained by this big insurance company to build traditional portfolios, and that involves traditional diversification, where you're trying to do large cap stocks, small cap stocks, some bonds with longer duration, shorter duration, foreign bonds, domestic bonds. And what we realized in the tech bubble bursting is that all that backward-looking portfolio construction is just that. It's backward-looking, and it doesn't really anticipate what's coming next. And so when the market starts to go through a crisis event, a lot of those previously non-correlated behaviors can become correlated. And that's just fancy talk for everything starts to go down at the same time.
So like 2008, for example.
Yeah, 2008, exactly. And so when I were going through the review process in like 2002, 2001, clients were starting to ask, well, Larry, how much worse do you think this is going to get? And I realized that I didn't have any answer. I had zero way to answer this except to say, well, it's never been this bad before. Breaking new ground. It's a terrible thing to have to share with a client because there's no confidence in that. There's just cheerleading, which is, trying to help people stay the course, which and they know is the right thing to do. But wow, in the moment, it is just devastating, when you watch your portfolio drop in value and you don't have any way of stopping it. And people just sort of accelerate to thinking, I'm going to lose all my money. And that's when bad decisions happen. And people, sort of force you to sell out, or you make the decision the only way to stop the pain is to sell the positions that are going down in value. And that's really, the market knows this and they can sense it. And as soon as you sell is when the market will turn around and start recovering without you. So that was the process that kind of forged this idea that we have to do something different. And what came out to be different is that the best way I've found to avoid losing money in stocks is to not own stocks. And so SynthEquity, or synthetic equity, is just a structure that allows us to mathematically use options to be able to participate in the movement of the underlying index without actually having all of our capital at risk.
Mm-hmm. Go a step further into that, like how you originally came up with the idea and packaged it and decided. And especially one of the interesting things to me is, when people have ideas, when they go through that moment transition, whether it's a gradual buildup or whether there's an aha moment to where you're like, actually, this is going to be a business. This isn't just an idea. I'm not going to let this one go.
Yeah, well, it was actually, it's a funny story. We obviously started trading options. It was in 2004, so it's been more than 20 years now. And the local supervisor who was in charge of supervising us back in the broker-dealer days couldn't pass the options principal exam to supervise us properly. And so the insurance company said we had to stop trading options. And clearly that was not going to be the case. So that's what sort of forced us to get out and start our own RIA in 2007. So
that's a great story.
Yeah, right. So I would probably have still honestly been with that insurance company and been happily, raising capital and doing my thing, but I was kind of forced to the curb.
Yeah.
And that worked out to be...
I'm not laughing at that. I'm just like, man, that's a great story. It's like, sometimes life throws you some things and it's like, wow, at the time you probably weren't exactly excited, but then, or maybe you were, I don't know.
It was, it was interesting, but really the genesis of all this didn't come out of, between my ears. It's an insurance product. Insurance companies have been building this stuff, whether it's called a defined outcome or a structured note. They have those things available, and they still do today. But the thing that I've done is just a small change in thinking. Because most of the product, actually, I'm going to be more strong than that. Almost all of the product that's built out there, I'm going to, give myself a little bit of leeway, is designed to kind of buffer or eliminate the first loss in a portfolio. In other words, they'll give you no downside, or they'll give you a buffer where you don't lose from 0 to minus 10 or minus 15%, but then they'll pick up the losses again after that kind of buffer. But in exchange for that, you have to put a cap on the performance, because there is no way to finance the structure of these things and give you full participation. If you don't do that,
they don't get some of that upside. So they're taking the downside from you risk, but they need some of that upside, and they need to turn a profit from that upside in order to continue in perpetuity, or, as long as they're companies, and managing that risk to be able to cap your downside. Yeah.
Right. So all we did differently is say, listen, we're investing, we're not buying bonds. So we appreciate the fact that we're going to be subject to risk, but let's take the first dollar risk. Let's actually lose money on the affordable side of the curve, which is the first 5, 10, 15%, and then not risk the unmitigated, who knows where the bottom is risk, which doesn't happen very often. I mean, it does happen, but it doesn't happen frequently enough, in my mind, to warrant moving like 40% of your portfolio into bonds under a traditional 60-40 portfolio. So that's really the key takeaway for us, is that we're going to risk capital and we're going to suffer losses occasionally, but we're going to suffer losses up to the point we've agreed to, and in a measured way. And that's because we're limiting the exposure in the loss side to the option piece, while we have this huge outsized, like 85% or more allocation to short duration treasuries, which is, definition of the safest asset class we have. So that's the thinking. And in exchange for that thinking, we don't have any cap on performance. So when the market does run strongly, which, by the way, it does more frequently than it loses, the investor can actually appreciate and get all of that appreciation potentially. So that's what really separates us, is that we are actively managing that option piece and harvesting gains along the way and putting it out of harm's way.
So how is this proposed, or how is this positioned in someone's overall portfolio? Like, how are you introducing this to investors?
Well, for us,
where does it fit?
It's a big ask, but it can be the core holding of a portfolio. Because if you think in terms of why we have all the different wedges, it's to achieve diversification. And if I can mathematically engineer out the risk of a severe drawdown, then actually I don't need the diversification, and I can concentrate my risk on the S&P 500. And I know that this is the case. No one ever comes into a cocktail party and says, "Oh my gosh, my balanced portfolio crushed it last year." That is just not what happens. It's people that take concentrated risk, they go big in a single position or, in an aggressive way. Those are the ones who really hit the home runs. And we're not taking individual positions like Meta or, NVIDIA. That's not our jam. That is over my risk tolerance as well. But we're taking a very concentrated position in options that are designed to move in a portfolio dramatically with a limited amount of risk at the same time. So that's what I think works really well. And it can be a big piece of the portfolio.
Yeah. And you were mentioning the 60/40 is kind of what you're comparing it against, right? So in terms of like portfolios, is that right?
Yeah, I mean,
traditional 60/40. And I'll tell you where I'm going with that is essentially for when you're thinking about age and individuals and investing. Is that like what you're comparing it to or just in general?
Yeah, I think here's an interesting angle. If we agree that like the 60 part of a 60/40 portfolio has the capacity, it may not do it very often, but it has the capacity to maybe lose 50% of its value. That's a big number, but it's real. And that 50% of 60%. Like
2002, maybe 2003, like tech wreck, like it just depends on where you're in. Yeah.
Or even in 08, and we even had like 34% decline just recently in 2020 with COVID.
Yep.
Now that rebounded really quickly, but the equity sleeve was hit pretty hard.
And it didn't have to rebound really quickly. You know what I mean? That's the part about when you're looking backwards. It didn't have to.
Yes, exactly.
It could have been in a depression or who knows, right?
Exactly. And so when you apply the math, and this is like, train station leaves the station stuff. A lot of people don't like to play games like this, but math is really important in this because you have to understand it to appreciate it. If the 60% goes down 50%, then you've already lost 30% in your overall portfolio, even though you've quote unquote softened up the liability. And then if your 40% makes 10%, and that's a big ask, asking your bonds to make 10%. Well, the 40% making 10% is only going to be a 4% credit, to your 30% loss. So you're going to be down like 26%. Yeah. That's a big drawdown, given the fact that it's a quote-unquote soft portfolio, right? Our portfolio, if you put 15% of the portfolio into options and 85% into treasuries, and you lose 100% of the options, you're down only 15%. So you literally have less risk, less like systemic risk than you would in a 60/40 portfolio. But when the market goes up 30%, like it can, our portfolios have historically performed that well or stronger. Like you actually get the full 30%. And meanwhile, the 60/40 portfolio, 60% of 30 is only, 18%? And then maybe the bonds go up 4% or 5%, so you get another point or two, so you get maybe a 19 to 20% upside. Well, that to me sucks. You're giving away the juice, the good stuff on the portfolio when the markets do run hard and hot, and you participate pretty strongly, frankly, on the downside. So this is a way that even people that are in their 60s and 70s, honestly, can expose themselves to more equity risk, but with a defined drawdown that's lower than a traditional portfolio. So how much of that would you want?
Yeah. So I see exactly what you're saying, and I see why it can work for many. What do you get as pushback on this? I'm curious. I'm going back to my financial advisor days and when I had an RIA, which has been a lot of years. I mean, at least 9 years I haven't been licensed, at least maybe going on 10. What kind of pushback do you get on something like this when you're talking to potential clients?
It's usually just the complexity of options or the mystery box of how this works.
Understanding it, right? Like understanding the math, understanding it seems, what's interesting to me is that it's not actually a highly, highly complex product, but when somebody's not used to it or if they have no exposure to options or if they don't, then it can be tricky to understand, huh?
Yeah, exactly. And I think there's also, to be fair, I mean, the options we buy are highly, highly levered. And that means that they're designed to move something like 10 times the rate of the market on a daily basis. So if the market's down, 1%, we would expect the option component to be down at least 10%. And conversely, if the market's up 1%, we expect the option bucket to be up 10 or 15%. So it has to, in order to be that small account, it has to move the whole portfolio. So it has to be that volatile. Now, what's funny, I had this conversation recently with somebody. I said, Bitcoin isn't even close to volatile enough to get the job done with just a 10 or 15% allocation. So just to give you an idea of what kind of volatility we're talking about.
Some investors would be right there, just even that. That could be something that would scare them off.
Yes, exactly. But the whole idea is that we're containing it to a small, controlled part of the portfolio. And I love analogies. And, a lot of us still use combustion engines. I'm in California, so there's a lot of Teslas on the road, but a lot of combustion engines are still out there. And really, just a couple of feet away from you by your feet is a series of controlled small explosions. literally compressed gas being sparked and ignited that propels you and your goal to your future destination. We can think of this portfolio the same way, that we're doing highly combustible, completely blow-upable options that can lose 100% of their value to propel the portfolio forward, understanding that they can and have lost 100% of their value, but they don't turn around and eat up the remainder part of your portfolio. The loss is contained to what we want it to be. It's the same concept. We're just using engineering to make a measured risk. And then we have to stand by and wait to see what happens. And there is also, the market has to move. If the market doesn't move, then these options start to decay in value. And you can suffer losses that are larger than what the market might have, but still to your budget, to your risk limit. So it can't run away from it. Or it can't turn into something we haven't expected to have.
Well, Larry, this has been great. I love what you're doing. It's a great. When I think about SynthEquity, I think for a lot of individuals, this is going to make sense. Well, I know we went through pretty high level today on the portfolio, what you're doing, and you got into the options a little bit, into the underlying volatility. But that being said, I'm sure there's individuals that may want to follow up and get some literature or CRC, how they can work with you and your team. How do people follow up? How do they connect?
Yeah, well, measuredriskportfolios.com is our primary website, and that's where we manage accounts for individuals and for advisors and their clients. So we're actively looking to create relationships with both retail investors and individual advisors who can work out an arrangement where we can be their sub-advisor and bring this portfolio to them and their clients. And then we've recently, just in March of this year of 2025, launched the SynthEquity ETF. So now our growth portfolio is available to where you don't need to hit a large separately managed account portfolio minimum with us. You can just buy it in almost any of the available platforms like Fidelity or Schwab or Interactive Brokers and many, many more. And you can learn more about that at SynthEquityETF.com.
Fantastic. And then congratulations, by the way. That's a step forward in giving other individuals access to portfolios who are in a strategy that maybe they wouldn't have to, because if maybe they didn't have the capital. But I like it. It's a democratizing of different. Why I'm a fan of ETFs many times is it's kind of democratizing or giving access to those that maybe couldn't get to a manager like yourself and otherwise. So that's great.
Yeah, well, that's the mission, is to help as many people as possible lean into investing for the benefits and limit the damage that, equity investing presents all the time.
And what was the ticker for that ETF again?
SynthEquity. So, Sam, Nancy, Tom, Henry, as in synth.
Yep. Wonderful. And for everybody listening, just so you know, we'll definitely put some links in the show notes, so you can just click on the links and head right on over and check out Measured Risk Portfolios. And speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. Each and every day we're bringing you new contacts, new ideas, and hopefully new inspiration to help you along the way in your journey as well. So again, hit that subscribe or follow button. And Larry, thanks again for coming on the show.
You bet, Adam. Thanks for having me.